Welcome to another episode of PyUncut, where we explore the human side of money. Because wealth isn't just about numbers, it's about behavior. Today's episode is inspired by Morgan Housel's timeless book, The Psychology of Money, a book that turns everything you think you know about getting rich upside down. Let's begin with a question. What if I told you that getting rich has almost nothing to do with how smart you are, and everything to do with how you behave? What if the secret to wealth isn't found in spreadsheets or formulas, but in understanding your own mind? Segment 1. No one's crazy. Think about the last time you saw someone make a money move that seemed completely irrational. Maybe they bought an expensive car they couldn't afford. Maybe they refused to invest, or they kept buying lottery tickets week after week. You probably thought, are they crazy? But here's the truth. When it comes to money, no one's crazy. Every financial decision a person makes perfect sense to them based on their life experiences. Maybe they grew up in poverty and learned that stability can vanish overnight. Maybe they lived through a time of soaring inflation and still carry that fear decades later. Our views of risk and reward are shaped not by data, but by personal history. You might have read about market cycles or compound interest, but someone else's education came from watching their parents lose everything in a recession. Same world, totally different lessons. So, before we judge others, or even our past selves, it helps to pause and ask, what experiences led to that choice? Once you see the story behind a decision, empathy replaces judgment. And that's the foundation for every other lesson in this book. Segment 2. Luck and Risk. Let's move to a story of two teenage friends, both brilliant, both obsessed with computers. Their names were Bill Gates and Kent Evans. One of them became one of the richest men alive. The other died young in a mountaineering accident. What separated them wasn't intelligence or drive. It was luck, and its twin, risk. Gates himself has said that if his high school, Lakeside, hadn't been one of the few in the world with a computer terminal in 1968, there would be no Microsoft. Meanwhile, Kent Evans, just as gifted, never got the chance. Luck and risk are siblings. They are the same force, working in opposite directions. We don't like to admit that because it means success isn't as tidy as we wish. But understanding this changes everything. It keeps us humble when things go right and forgiving when they don't. It reminds us not to idolize the winners or condemn the losers, because both are often riding the same unpredictable wave. Segment 3. Never enough. Here's another uncomfortable truth. The hardest financial skill isn't making money. It's knowing when to stop chasing more. History is full of people who had everything and still risked it all because they couldn't define enough. Rajat Gupta, the former CEO of McKinsey, was worth over $100 million, but he wanted to be a billionaire. That desire pushed him into insider trading and prison. Bernie Madoff had a successful business long before his Ponzi scheme. He didn't need more money, but he wanted more admiration, more status. And that need destroyed him. Enough is a moving target. Social comparison makes sure of that. There will always be someone richer, flashier, or younger doing better. The antidote is perspective. Author Joseph Heller once told Kurt Vonnegut, "Yes, that billionaire made more money today than I ever will, but I have something he will never have. Enough." It's such a simple word, but it might be the single greatest wealth protector there is. Segment 4. The real magic, compounding. Let's talk about what really builds wealth. Not luck, not intelligence, not timing, but time itself. Warren Buffett's fortune is over $80 billion. Here's the mind-blowing part. More than 80 of that came after his 65th birthday. His secret isn't that he's the best investor in the world. It's that he's been a good investor for longer than almost anyone else. He started early, stayed consistent, and let compounding work its quiet magic. We underestimate compounding because our brains think in straight lines. We expect progress to be steady. but compounding grows like a snowball, slow at first, then suddenly unstoppable. The takeaway is simple. Don't chase the highest returns. Chase durable returns, good enough returns that you can stick with for the longest possible time. That's when compounding goes from arithmetic to magic. Segment 5. Getting rich versus staying rich. There are a million ways to get rich, but there's only one way to stay rich: survival. Getting rich takes optimism, boldness, and a willingness to take risks. Staying rich takes humility, frugality, and paranoia, the kind that whispers, "This could all vanish." Jesse Livermore was a legendary trader who made the equivalent of $3 billion during the 1929 crash. A few years later, he lost it all. He didn't survive. Warren Buffett, on the other hand, built his wealth by avoiding fatal mistakes. He kept cash on hand. He never bet the house. He didn't panic during crashes. He simply stayed in the game, long enough for time to do its work. Financial success isn't about brilliance. It's about endurance. Segment 6. Freedom, the highest dividend. So what's the point of all this money talk? Is it a bigger portfolio, a fancier lifestyle? Not really. The highest dividend money pays is freedom. The ability to wake up and say, I can do whatever I want today. That freedom might come from having a big investment account, but more often it comes from living simply enough that you don't need much to begin with. Psychologist Angus Campbell found that the strongest predictor of happiness isn't wealth itself. It's a sense of control over your life. Money can't buy happiness, but it can buy you the time and autonomy to build it. Segment 8. Wealth is what you don't see. We often mistake visible richness for wealth, the big house, the designer car, the watch, but true wealth is invisible. It's the money not spent. It's the flexibility, the savings, the unbroken nights of sleep. A rich person buys things. A wealthy person buys time. Remember this line. When you see someone driving a Ferrari, all you know for sure is that they now have less money than they did before. Real wealth is quiet, and that's why so few people ever notice it or achieve it. Segment 8. Behavior over brilliance. After all the stories and data, Morgan Housel leaves us with one simple truth. Doing well with money has little to do with what you know and everything to do with how you behave. Financial success isn't about IQ, spreadsheets, or insider tips. It's about patience, humility, and self-awareness. You don't need to outsmart the market. You just need to outlast your impulses. That's the psychology of money. Thanks for listening. If you found value in this episode, share it with a friend who's chasing more. And remember, the ultimate currency isn't dollars. It's freedom.